The biggest struggle right now in the market that we're seeing is just purely the competitive nature of M&A because the market has been extremely blurred.
What is the biggest red flags you're seeing to help clients spot issues before the deal closes?
The biggest thing that our clients see that would break a deal is churn, or the allocation of recurring versus non-recurring revenue.
What is transaction services?
Transaction services, as an umbrella, covers a number of different services, one being financial due diligence, another being tax due diligence, another being operational due diligence. As our job, it's really identifying risks, opportunities, challenges, and things that our clients can really hang their hats on in terms of the key insights and KPIs that help them make the best decisions that they possibly can before they actually sign the papers and acquire this business.
Ever wonder who keeps the deal train from flying off the rail while millions or billions are on the line? Meet Nicholas Spezio, the guys private equity firms actually call when it's time to kick the tires, pop the hood, and make sure the business they're buying isn't about to burst into flames. With over 150 transactions across SaaS, fintech, and beyond, Nicholas knows what makes a deal sink or scale. On today's Executive Connect podcast, we're talking about transaction services where strategy meets spreadsheets and fortunes are made or lost in the fine print. Welcome, Nicholas.
Thank you very much. I love that.
Now, you built your career at the center of some pretty serious high-stake deals. What initially drew you to transaction services, and how did your global career journey from New York to New Zealand shape the way you approach deal making today?
It's a great question. I started my career off in public accounting. I started at a top 10 firm, moved over to PwC, a big four firm, auditing big hedge funds. My first client was Tiger Global. I was a young 25-year-old, just sort of starstruck by Tiger, going up to the Solo West building overlooking Central Park and auditing these big, massive hedge funds and private equity funds. And just had this allure and sort of just wonder of what private equity was and how these different fund managers bought businesses and what the strategy was and how they did these turnarounds and grew them and then exited them. And from an early young age, I always was curious and interested in private equity. And as I continued to get more experience, went to New Zealand and did some time there, Argentina, India, all these different places at PwC. This opportunity came up at Expo Group to head their transaction services practice. And after 10 years of audit, I really had this decision to make, either to stay in assurance and audit at PwC, which I thought that was the natural path for me to either make MD or partner, or to take a leap of faith and join this startup advisory firm that was 6 people at the time and head transaction services, which I actually had never done before, and learn financial due diligence. And I said, you know what? At a pivotal point in my career, I don't have any kids yet. I'm not married. This is a perfect opportunity for me to try something new and try it in an industry that I'm really interested in. So I decided to take the leap of faith, and I'm really happy I did. It's been the best decision of my career by far.
I love that, Nicholas. That's such a testament. I think taking the leaps are really important in our career journeys. So I want to talk a little bit about what transaction services actually are and kind of open that hood. So let's demystify it for our listeners. What is transaction services? And can you break down what your team actually does and why it's critical for both the buyer and the seller?
Ready to lead smarter and invest wiser? On the Executive Connect podcast, we unpack executive strategies for wealth and influence. Hit the subscribe button now. Don't just watch, act.
Absolutely. Absolutely. So transaction services as an umbrella covers a number of different services that goes along the lines of an actual transaction or M&A event or buy and sell. And so for us, as part of our transaction services practice, we offer a couple different services along those lines. One being financial due diligence, another being tax due diligence, another being operational due diligence. And so what we do in terms of our financial due diligence is deliver a product to our clients or investors called equality of earnings. And what equality of earnings is, it's a word that probably a lot of people hear and say and think about, but equality of earnings is really understanding truly what the quality of a target company's earnings are. So when you look at an income statement or a P&L, you can see what the income is, or the adjusted income or the EBITDA, but that doesn't tell you the full picture or depict everything that you need in order to make good decisions. And so what our job is in determining what the quality of the earnings is also understanding the revenue, the quality of the revenue, breaking out what the revenue looks like. Is it recurring versus non-recurring? Is it one customer driving all the revenue? Is it the top 10 customers driving all of that revenue? Is there certain revenue recognition implications that we need to think about in terms of deferred revenue? And then understanding the expenses as well. Is there supply chain considerations that we need to think about? Is there supplier concentrations? And so really breaking down what their P&L, what their balance sheet looks like, understanding the true recurring nature of the P&L and the revenue and their earnings, and whether this is something that's investable and whether there's a growth trajectory, and what we really think about the business. So as our job in doing financial due diligence, it's really identifying risks, opportunities, challenges, and things that our clients can really hang their hats on in terms of the key insights and KPIs that help them make the best decisions that they possibly can before they actually sign the papers and acquire this business.
And it seems there's a ton of M&A going on in the world today, Nicholas. It seems even the big companies are merging with each other. So it doesn't seem like this space is letting up anytime soon.
That's right. I'm Q1 and Q2 is normally our slowest quarters, and it's been our busiest 2 quarters since I've joined in 2021. So it's been very, very active.
I love it. It keeps things exciting and interesting. Now, from my understanding, private equity firms and venture capital firms don't like surprises, at least not the financial kind. So, what is the biggest red flags you're seeing to help clients spot issues before the deal closes, and maybe some insights on what they can do to navigate not taking those risks?
The biggest thing that our clients see that would break a deal is churn, or the allocation of recurring versus non-recurring revenue. And so what churn is really defined as is customers leaving the business. And a lot of the times they're measuring the net retention, the gross retention, the net churn, the gross churn. If our clients are underwriting a deal based on an annual recurring revenue number and they think that their retention is X percentage and it falls far below that number, that's usually a major red flag to them that they need to then investigate to understand why are so many of the target companies' customers churning, and what are the downstream implications to that? How many customers do they then need to acquire or embed back into the business because they're losing this many customers? And what's the acquisition cost to getting more customers? And why are they losing them? Are they losing them to competitors? Are they losing them because their product isn't as good? Are they losing them because of their customer support? Are they losing them because of pricing? So that's a big piece of it. And then I think other pieces of it is, if the adjusted EBITDA figure comes in far below what they expected, and potentially if they got a sell side QOV or used a banker and there was aggressive adjustments, meaning they are baking in far more add backs, what they're called, to EBITDA, then they could really hang their hats on. So we see that a lot. There's a big gap between the adjusted EBITDA that's presented to us by bankers or sell side QOVs versus what we believe the true adjusted EBITDA is. And because you're talking about millions of dollars, you have that delta between what we think adjusted EBITDA is versus what they think adjusted EBITDA is, times whatever the multiple is of the deal. And that's the true magnitude of EV that we're talking about. And that can then cause some contention between a buyer and seller and how that kind of gets worked out. So those are issues that we see.
Yeah. Is there a specific sector that's struggling a bit right now? Or, I mean, I work in the tech sector. I see that there's a ton of competitors out there. So a lot of the churn has been through price and more players in the space now. Is that similar for all sectors right now, or any insight on that?
Are you someone with a demanding job, but tired of the 9-to-5 grind? What if you could build a profitable side hustle without sacrificing your full-time career? Our new partner, Book Profits, can show you how to turn your limited free time into a thriving online business. Learn how to find, sell, and profit from used books, all on your schedule from the comfort of your own home. Not crazy tech skills needed and no major upfront investment, just simple strategies that fit into your busy lifestyle. Visit the URL on the screen for a free training today and learn more.
We do a lot in software. I'd say 75 to 80% of the deals that we do are in software as well. I wouldn't say that there's been significant challenges in terms of churn. I mean, there's certain customers or like vertical segments of what we look at that may be struggling more than others. The biggest struggle right now in the market that we're seeing is just purely the competitive nature of M&A, because the market has been extremely blurred. I think historically it was much more fragmented, where you had big blue chip Excel KKRs, the big funds, Blackstones, BlackRocks buying big businesses in the upper market, and then the next series of funds buying in the middle market, and then you had your smaller PE funds buying in the lower middle market, and then you could kind of see how each of those funds interacted and buying those businesses and then exiting to a little bit more upstream. What's become sort of the norm now is the market is just completely blurred. You have really big shops coming all the way downstream and buying businesses from smaller shops. And so that is making the market much more competitive. And we're seeing a lot of our clients get priced out of deals because they're not willing to pay the multiples that they're seeing right now on annual recurring revenue, ARR. So that's been like the biggest struggle right now, just the pure competition in the market.
I love it. So on the flip side, literally you also help the sellers prep for due diligence.
Yeah.
So what does it take to make a company deal ready in today's market? And what separates the smooth exits from the painful ones?
Preparation. Preparation is the biggest thing. And I feel like I almost exhaust myself in trying to, I don't want to say convince sellers that they should do a quality of earnings, but it's almost like if you were going to sell your house and you had the ability to do an inspection, a pre-sale inspection of your home, and that inspection gave you a report of everything that you could fix or upgrade prior to selling and going to market. And you knew that if you fixed those things, it would be extremely accretive to you in the way of, I don't know, multiple turns on your business. Everybody, I think, would do that and take that report and be like, oh, I can fix this, I can fix this, I can fix that. That's the same thing in terms of doing a sell side quality of earnings and doing tax due diligence up before you go to the market, because the sell side QV is going to do a couple things for you. It's going to protect purchase price for you because you're going to get an adjusted EBITDA number up front that we can all agree on that that's the true adjusted EBITDA, and then using market comps or whatever we think, this is the true purchase price or this is the true enterprise value, and we're in the driver's seat versus a buyer coming in, adjusting EBITDA and telling you what they think EV is. We're going on the upfront and we're saying, okay, this is what we think EV is. And then the other big thing too is a lot of times when sellers are going to market and exiting their business, this is the first time or maybe the second time they've ever done it. So they're not getting as many reps into doing this. And so they're already at a disadvantage because buyers are buying a lot of times multiple businesses as part of their roll-up strategy or as part of their inorganic growth strategy. And so the other big thing is net working capital and working capital optimization. So getting ahead of working capital and saying, hey, these are the things that we want to put into working capital so we can protect purchase price and not get it baked into debt or debt-like items where they get a dollar for dollar purchase price reduction becomes really, really important for sellers. So that's our big kind of selling piece, is like you paying for a sell side QV will pay for itself because we're going to identify these issues for you up front, and then we can better prepare as we go to market. We can understand what the true key metrics are. And then the other piece is we're going to shoulder and we're going to shield you from all the questions that come from the buy side when they do come in. So we're going to have everything already prepared for you. It's going to make this process a lot more seamless for you. So I think it's a really valuable product for sellers, but it's kind of a mixed bag on whether they invest in it or not.
No, I love the analogy to the home buying. I think that's so spot on. And do you find that the sellers sometimes, maybe they think they have different numbers than you do? Do they go back and say, okay, I need to, fix this area, fix that area? Do you find that a lot of them push forward or a lot of them go back and, rework things, increase revenue before they sell?
That's a great point. Oftentimes when we do go to the table to present our findings and what we believe the adjusted EBITDA is they then have that opportunity to say, wow, that's exactly what I thought, or wow, that's way lower than I thought. So maybe it is worth waiting another 6 months because our pipeline looks like this, and we think our contracted ARR is this, and we think we can go to market with even more of EBITDA and a higher run rate if we wait another 6 months. So that's the beauty of it. Is like, my advice to sellers is always don't rush to market. And again, we're like 95% on the buy side, so we don't do as much sell side. But when we do, I'm like, this is only going to be helpful for you. Like, you are going to know all of your numbers. You're going to get a beautiful report. You're going to know what your adjusted EBITDA is. And then you can be patient with what the results are in terms of what your decision is to go to market. Like, there's no rush here. So it can only benefit you, in my perspective, in terms of getting the numbers, getting the adjusted EBITDA, understanding what your churn is, understanding what your retention is, understanding what your customer concentration is, understanding what your DSO is. And then you can start to put together what the story is, because you want to present the facts, present the past, but you want to sell the future, sell the story. And so that's what we're really trying to do is with our report is put together a good story for the market and for the buyers.
I love that. I think it's brilliant. I want to talk a little bit about some industry trends because I love what's hot and what's not. So you've worked across SaaS, fintech, ed tech, and more. What trends are you seeing in the deals right now? Is there a specific trend you're seeing? This episode sponsor is a couple I absolutely love, David and Alexis Kiwi. They help power couples be successful at home just like they are at work. If you're crushing it in the business world but quietly disconnected from your spouse, you're not alone. Check them out at davidandalexis.kiwi.org. They have spent years creating a simple tool set that will help you save your marriage. Don't forget to use code EXECUTIVE1 to save $500 off their 6-week coaching program. davidandalexis.kiwi.org, code EXECUTIVE1.
One trend that we're seeing is more on the deal, like on the purchase agreement. Excuse me. So oftentimes, there's this notion of working capital, which is always kind of like the bane of sort of everyone's existence, because for a seller, like on the buy side, we have to explain what working capital is. And then there's the negotiation of what accounts actually go into working capital. And then there's like the agreement of what the peg is, which is like the normalized working capital based on some historical period, normally 12 months. And so you have to create this working capital depiction, and then you come up with a peg, and then you estimate the working capital as of the close date. And then there's adjustment to purchase price based on what you've said, all these things, and then the purchase price either goes up or goes down by this. And it's a lot for people to understand, especially sellers, and it always is like an issue. So one thing we've been seeing buyers do that I think is really creative and really helpful for both sides is cover working capital under customary reps and warranties, meaning there is no adjustment. They basically are saying, continue to run the business the way that you have. And if you continue to do so, there won't be any issues. Working capital will just be what it is. And then we can continue to own and operate the business from what the working capital is left over in the business. There's no need to adjust it at closing. There's no need to true it up post-closing. It just is what it is. And it's a much more efficient and cost efficient too, because you don't have advisors like myself that has to do the estimates and then true it up for the closing statement post-close and explain all these things. And then if there's, conflict, having to go through that. So, and normally like it's pretty de minimis as well. Like it goes in either direction, but it's the time investment to explaining it, putting all these things together. So that's a really interesting trend that we've been seeing work really, really well for both sides.
And I'm curious because I live in Austin, of course, and a lot of founders and investors and AI companies are moving here. Is there anything that, startups should be looking at as they move forward into 2025, as they're considering selling their business? Is there anything that you kind of projecting at would suggest to them?
Yeah, I mean, the biggest thing, because we're working with some venture investors and they're interested in a lot of really interesting early stage businesses, AI businesses, advanced tech businesses. And as interesting and as game changing as the technology is, we've seen a lot of deals stall or even break because the portcos or the targets operationally don't have any sort of controls. They don't have any sort of operations. They have no way of getting the financials over to the investors. They don't have any underlying support that corroborates what their financials are. And so my biggest suggestion for very, very early stage businesses is really focus on your operations, making sure you're thinking ahead to when you actually expect to take on investors and working backwards from there in order to get everything that you need into a good place. So when someone starts knocking on the door and asking for these things, you're already prepared and you're not working sort of backwards like, oh my God, how do I put together all these contracts and all these invoices and every, like those are things that you can fix now, but you really should invest into putting together all of those things that make your business run properly.
I love that. I think it's such great advice. It's so rudimentary in what you said, but I've seen so many companies not do exactly what you said, like have a plan, make a plan. Where are we going? So I think that's such an important thing. And I want to go back to what we were talking about at the beginning and talk a little bit about career advice and for people that are aspiring to be like you and do like you and maybe even M&A professionals. And so for those who want to go into this space, I want to get your insights on what skills or mindsets or, things they need to have in this world we're in today.
For me, it was always a confidence in myself. Like I was always willing to put the chips on me. And as I continued to get more and more tenured at PwC, and I wanted more and more and more and more, but because of just the way that those bigger firms were structured, even though I felt like I was outperforming my peers, there wasn't that differentiation in terms of like what my comp would be, what my title would be, because it's just so structured. Um, but Expo provided me with that opportunity to really bet on myself. I mean, I joined Expo Group as the head of transaction services, but I was the only person on the desk. It was really just me at the time. And so it gave me that opportunity to put the chips on myself and just really work hard to try to do this. And it was just the fact that I would never stop working. Like I would just read every single M&A book I could get my hands on. I read investment banking books. I read as many M&A books and legal books about M&A, just anything and everything that I could, as well as leadership books to be the best professional that I could, because I knew the stronger that I got, the stronger the desk could be and the more business that we could ultimately bring on. And I think the other piece of it is I have a natural curiosity to be a learner and to be the best that I possibly can. And so I think that coupled with having the opportunity to grow this as much as I possibly could really helped fuel the fire for me to take on this opportunity and to help lead it. And like I said, it was just a perfect kind of storm in terms of joining at 6 people, 7 people. I was the only person on the desk, and now we're close to 70 people in 4 years, and there's 20 people on the desk with me now for TS. So it's just that I think hunger and fire to learn, to be a sponge, to learn as much as possible, and to really help lean on my clients and ask them a lot of the technical questions. Like when I was trying to understand working capital and debt like and different working capital strategies and purchase price strategies and how to structure earnouts and how to structure rollover equity and how to think about asset deals versus equity deals. Like those things I just didn't naturally know. And so I had to find people that I trusted within the industry that were my connections that I could be like, hey, can you explain this to me? Like, why do you do it this way? Like, why are you thinking about min cash this way? Like, those were things that I used to my advantage in terms of building my network and finding people that I could have honest, candid, and trustworthy conversations with that would help me navigate some of those more complex areas.
I love that. I think the need for education and the need to learn more is such an important skill these days to want to learn. And I love that you kind of took this role and you were the only person on the team because it probably really gave you the opportunity to lean in and focus on learning and developing and making plans. And I love that you share that because I think it's such we all see things a different way, and really to take the time to step back. That had to be like a huge shift for you going from, leading teams to, being an individual contributor. Now, were there moments for you that you felt like, "Oh my gosh, did I make the wrong mistake? What did I just do?" Did you have any of those moments?
Yeah, definitely. I mean, the first 6 months, I was like, I forgive me, Kevin and Eric. I was like, I think I gotta go back to PwC because it was so unstructured. Like there wasn't playbooks, there wasn't the technology I was used to at PwC, there wasn't processes set up, there wasn't templates, like there wasn't all of the structure that I had become so accustomed to. I lost kind of overnight, lost all my mentors at PwC that I could go into their office and then ask them these hard questions or go to lunch with them. Like it was all of a sudden I'm on this island and I have to build everything myself and I don't have the same resources that I did. So it was really, really hard. I mean, to do the deals myself from start to finish, to learn the processes, to learn M&A, to building the team, to hiring, like it was a lot. I mean, it still is a lot. I mean, there's a lot of pressure. It's a little bit of a commoditized industry. There's a lot of really strong firms in the marketplace and the industry has become extremely fragmented. There's obviously all the big shops that are really, really good that we compete against, but there's a lot of really small shops too that are boutique and high end too. So, I mean, it's just a very, very tough industry, professional services. Like, I don't want to say you're only as good as your last deal, but there is that pressure to constantly do well and to exceed and, to perform at a high level. So, yeah, I mean, there was a lot of times where I was like, PwC was a lot easier than this. So,
Yeah, and I think, getting comfortable is a really bad plan in today's world. I feel like, my career 20 years ago, I just could focus on my one task, my one job, my one role. I think where we are today and the world is moving so fast, the tech is moving so fast. So just to have like these AI companies that, have these huge evaluations and then their evaluations go completely poof, right?
yeah.
I think it's really important to stay agile, to stay educated, to stay on point, and to continue to build that plan. Because what I heard you say, and maybe you didn't say it, is you were able to sit down and build things the way you wanted from the ground up versus given a playbook that you had to work against. And so I think that's a beautiful thing because you've been able to learn so many different things and now you are exactly that, a Swiss Army knife for all these different pieces that you therefore wouldn't have been had you not left. So kudos to you for taking the jump. I love it. I'm thinking of like how much work that must have been because I've been there before and I know long weekends, long nights, sleepless nights. And so here you are on the other side. Is there anything you would tell your younger self?
Ah, that's all gonna be okay. It's all gonna work out. Just keep your head up and, just keep taking deep breaths and I it's hard to get lost in the day to day, now being almost 36 years old and doing this for, I don't know, 13, 14 years now. Like, I actually went to this leadership training last week for Tech Week in New York City. It was hosted by Ripe at Othership. It was awesome. And one of the things that really resonated with me was they were talking about gearing down and how high performers are always in the high gear. And definitely I've been hurt by that a lot because you're always trying to do more. You're always trying to work harder. We're all, barely take any time off. You're trying to grow. You're trying to take on new deals. You're trying to, trying to push to that next level. But then you get to a moment and you're like, wow, I'm like, pretty burned out here. Like, how did I get to this point? And I think what I would tell my younger self is like, this is a marathon, a very, very long marathon. you have to be able to take rests and know when to slow down and know when to gear down, and like everything will work out, and actually it will benefit you when you do gear down. And that's one of the biggest things I tell my younger teammates and even people that I network with that are looking for advice. I'm like, work hard, but you need to know when to kind of take it down a notch and recuperate and rest and come back at it the next week with a full head of steam. So that's what I would tell myself.
I love that you said that. That's such important advice as a similar, all in, go get 'em, can't stop, won't stop personality. There's something special in gearing down and leaning into your family or leaning into a hobby and letting your mind rest is such an amazing thing because you could dissect the things that are going on quicker and faster without overthinking it, I feel like for me. So I love that you shared. I think that's such great advice. I want to before we close, I want to get any final things you want to share that we haven't touched on about M&A and what executives, business owners, and entrepreneurs should be thinking about.
I mean, look, if you're interested in buying a business, if you're a strategic or a private company and you want inorganic growth, the big thing is just, we just did this as our own kind of leadership retreat, is understanding what your plan is, understanding what your true strategy is of your business, and then truly understanding internally what your strategy is, then deploy that outward when you go out and buy a business and actually go to acquire. It's a pretty strenuous process of buying a business. There's a lot that goes into it. So, you need to do your due diligence. It's worth that investment to understand financially what they're doing from a tax perspective, whether they've been filing correctly, if there's any implications for sales tax and payroll, operationally what they're doing. It's a big, big investment. So just kind of strap in for that. And then if you're a seller looking to potentially exit, you've owned a business for a long time or maybe not, when you do look to exit that business, it's also very, very important to reflect on why you're selling, who you're looking to partner with, or who you're looking to hand these keys over to, and to put together a good roadmap for what you want this to look like, and to get advisors involved as soon as you're ready to, because they're going to help you put together what you need in order to maximize value. And that's really what you want to do, is you want to maximize value, you want to find the right partner, and you want to set yourself and your employees up with a good partner to lead your firm in the next 5 or 10 years. So that's what I would lead them with.
That's great advice. Now, this has been a deep dive into the world that most people never get to see up close. For listeners who want to learn more about Expo Group or connect with you, where might they go?
Email nicholas.spezio@expogroup.com. Our LinkedIn page, Expo Group, or even myself on LinkedIn are great avenues to reach me.
Thank you so much for being here today and sharing your knowledge with our listeners. That's the Executive Connect podcast.
Thank you for having me.